And of course, it may seem like in chapter 1 we were already recording transactions, but the way that we did it in chapter 1 is not actually the way or using the format that you would use if you were working in financial accounting. So the way that we're going to do it in chapter 2 actually is exactly the way that you would enter transactions if you were working in financial accounting. And at first, some of this might seem kind of complicated, but once you've been working with it for a while, it will get a lot easier. So just bear with me. It's going to seem kind of foreign to you at first, but it will make sense, I'm sure, after a while. We used the word account last week and the week before, but we really didn't define what we meant by the word account. So an account is the detailed record of all the increases and decreases that have occurred in an individual asset, liability, or equity during a specified period. So cash, for example, would be the name of an account. Asset is not the name of an account. Asset is a category of account, and cash is an actual name of an account that would fall within the category of accounts called asset accounts. Here's a chart of accounts. A chart of accounts is just a list of all of the accounts that a particular business uses for their accounting. And if you're working in financial accounting, you often refer to a chart of accounts because when you're going to record a business transaction, you may not recall what the names are of all of the accounts that that particular company uses. So a week or so ago, when I was working with an air conditioning company that I do accounting work with, they were saying they just purchased a forklift truck and they weren't sure what account to put it in. And so we had to look at the chart of accounts to see what account name do they have that would be most appropriate to put a forklift truck in. And looking at this list of accounts, they don't have one. So we would probably set up another account called equipment, but if they had an account called equipment, that would probably be the account that you would want to put the forklift truck in. Now, notice that a very typical way of laying this out for the chart of accounts is that you divide the accounts into 5 categories: assets, liabilities, equity, revenues, and expenses. And you use a numbering scheme. This is typical. There's nothing that says in GAAP accounting that you have to do it this way, but it's very typical that your asset accounts start with the digit 1, your liability accounts start with the digit 2, equity accounts start with the digit 3, revenue accounts start with the digit 4, and expense accounts start with the digit 5. Now, in chapter 1, we were treating revenues and expenses as being part of equity. But starting with this chapter, we're going to think of them more as being separate categories of accounts, and we will call those revenue and expense accounts income statement accounts. At the same time, the ones that are assets, liabilities, and equity, we will refer to those as being balance sheet accounts. When we record a transaction, there are always at least 2 accounts that are affected by this. We already saw this really in chapter 1. The type of accounting system that we use in the United States is called a double entry system. It's double entry because we have to record effects involving at least 2 accounts at the same time. So as an example of a transaction, office supplies are purchased for cash. So the account for office supplies would be increased. The account for cash would be decreased. Now, to keep track of the balance in an account, we're going to use an analytical tool that we call a T account. And so it's shaped like a T, and the example that you see here near the bottom of the slide is a T account for the cash account. And when we make an entry to the cash account, we may make an entry to the left side of the account, in which case we will call it a debit, or we may make an entry to the right side of the account, in which case we will call it a credit. Sometimes debit and credit are abbreviated. Debit is DR and credit is CR. You notice the word debit does not have an R in it, but the reason it's abbreviated as DR is apparently this comes from the French, because the French were the first ones to use a double entry accounting system. Now notice that I'm not saying whether it's a debit that increases the account or a credit that increases the account. The reason I'm not saying that is that it all depends on what category of accounts we're talking about. There's no universal rule that would apply to that. So here, with this diagram, we see the general rules for this. If it's an asset account, an increase in the account would be shown with a debit on the left side. If it's a decrease in an asset account, that would be shown with a credit on the right side. If it's a liability account or an equity account, then the rules are the opposite. So for those accounts, they would go up with a credit entry on the right side. They would go down with a debit entry on the left side. I think basically the reason the rules are the opposite for liabilities and equity has to do with the fact that we have to keep the accounting equation in balance when we make these entries to the accounts. So going back to our example of the cash account, if we want to show that cash has increased, then we show a debit on the left side. We show cash going up by $30,000. Then if we want to show that cash is going down by $20,000, we would show a credit entry on the right side with $20,000 to show the decrease in that instance in our cash account. Now, here's an expanded diagram of how the rules of debits and credits work. So you'll remember back in chapter 1, we said with equity that common stock and revenues cause equity to go up. Dividends and expenses cause equity to go down. Therefore, the general rule that we gave for equity applies to common stock accounts and to revenue accounts. But the opposite rule applies for dividends and expenses. So the rule that would apply to dividends and expenses is actually the same rule that applies to asset accounts, where those accounts, dividends and expenses, go up with a debit and go down with a credit. This is the diagram that I would suggest that you refer back to quite frequently when you're working on the homework or taking the chapter exam for this chapter. You could print this out from the PowerPoint slides or from the e-text, or if you have the paper copy of the textbook, you could mark in the book where this occurs as well. But this diagram is going to be very helpful to you because, you know, if you're making an entry that involves the common stock account, it's probably going to be hard to remember at first. Does common stock go up with a debit or does it go up with a credit? So you could refer back to this diagram and it would give you that information right away. Now, every one of our accounts has what we call a normal balance. And the normal balance is the side of the account that causes it to go up. So an asset account goes up with a debit, so the normal balance for an asset account is a debit. Liabilities and equity go up with a credit, so the normal balance of those accounts would be a credit. And here's an exhibit that comes from the textbook too. Notice the column that says increases, that column is identical really to the column that says normal balance. Whatever side of the account causes it to go up is going to be what we call the normal balance for the account. So if it's a cash account, which is normally an asset account, or it is not normally, but a cash account is an asset account, then the balance in the cash account we know would normally be a debit balance. It would be hard for it to be a credit balance because a credit balance would mean that you have negative cash, and that usually does not happen. Okay, when I say balance, here's how we compute the balance. And we may only balance the accounts at the end of the accounting period, although when you do problems in MyLab, they may ask you to balance these accounts more frequently than that. Here for the cash account, we see that there were 2 debit entries that were made, increasing the amount of cash. There were also 2 credit entries made, decreasing the amount of cash. The way we determine the balance at the end of the period in the cash account is that we add up all of the debits, which in this case would come to $35,500. Then we add up all the credits, which would be $23,200. Then we take the difference between the debits and the credits, which would be $12,300, and we put that difference on whichever side is the greater of the two. So the greater side here is the debit side, so that's where we put the balance of $12,300. And as we were saying before, the normal balance for cash being an asset account is in fact a debit. So it's not surprising here that the balance would be on the debit side of the cash account. Okay, when we are making these, when we are recording our transactions, what we do is we first look at source documents. And source documents are anything that gives us a record of the transaction. So it might be sales invoices, it might be bills that we've received from our vendors, it might be a cash register tape, it might be a check that was written, but it's something that documents exactly what the transaction was. Then we are going to record the transaction in what we call a journal. Now, historically, a journal is a book. And nowadays, most accounting systems, I should say, are computerized. So we don't typically use books anymore. But in terms of the way that the data is organized, I think it's still pretty useful to think about this in terms of it being a book. The journal is a book where every transaction is entered in chronological order. And so what you see at the bottom on the left side of the slide here is an example of a journal entry, an entry that would be made in your journal, where first you put the date, November 1st, then you put the debit account, which here is cash, and the amount of the debit, $30,000. Then you put the credit account, and in the credit column, you put $30,000 for common stock. And then below that, you typically put an explanation that tells you why you had that transaction. So here, the explanation would be issued common stock. In my lab, about half of the time when you make a journal entry, they want you to include that explanation at the bottom, and you'll pick it from a drop-down menu. The other half of the time, you'll skip that step of having the explanation. So you just have to look at each problem and see whether they're actually asking you to do that part of it or not. Notice here that if we were doing this on paper or in a book, that the credit account, common stock, would be indented. It's indented from where the debit account is. So that sort of signifies to us that that in fact is a credit. Now, when you're doing this in my lab, you don't have to worry about indenting. You just enter the credit account wherever they give you a space to enter it. So that's not going to be an issue, but if you were doing this on paper, you would indent the name of any credit account like that. Okay, then after you have entered all these transactions in chronological order in the journal, the next thing you do is copy them to another book, which is called the ledger. And the word that we use, instead of calling it copying, we call it posting. But posting means the same thing really as copying the transactions over to the ledger book. Now, the difference with the ledger book is that instead of being organized strictly chronologically, it's organized by account. So every page in the ledger book is for a different account name. So if we were posting this transaction to the ledger, we would find the page in our ledger book that is for the cash account. And there, as you can see in the example here, we would put a $30,000 entry on the debit side for the cash account. Then we would find the page in the book that is for the common stock account, and there we would put a $30,000 entry on the credit side to show that common stock was going down. So to summarize, the big difference between the journal and the ledger is that the journal is strictly chronological. The ledger is organized by account, and therefore we would use the ledger to determine what the balance is in each one of our accounts when we get to the end of the accounting period. Okay, we're going to go through a series of transactions here, and quite a few of these transactions will be the same ones that we covered back in chapter 1. So these may sound very familiar to you, but what we're going to do now is we're going to do journal entries for these transactions that are in fact just exactly the way that we would do them in financial accounting. And then beyond that, we're going to post these entries to the ledger, the next step in the process after that. So the first transaction says on November 1st, the e-learning company received $30,000 cash from Sheena Bright, and the business issued common stock to her. So the way that we would analyze this transaction is that we would say that cash is an asset account, cash is going up, and the rule for an asset account is that it's going to go up with a debit. So therefore, we know that for cash, we're going to show a debit to that account. And then common stock is going to be increased. And common stock is an equity type account that goes up with a credit. So we know that we're going to show a credit entry for common stock. So now we can prepare our journal entry. We start with the date, November 1st. Then we always show the debit first. So we put the debit for cash, $30,000. Then we put the credit to common stock, $30,000. And then below that, we put the explanation which says issued common stock. As I said before, the credit account is indented, but you're not going to have to worry about indenting it when you do this in MyLab. Okay, then next we would, you don't always do this after every journal entry. Sometimes you wait till the end of the day or the end of the week or the end of the month, but in this case, the next step right away is that we're going to post this to the ledger. So we find the T account in the ledger for cash, and we show a $30,000 debit entry to the cash T account. And we put the date next to that, November 1st. Then we find the T account for common stock, and we put a $30,000 credit entry in common stock. And we also put the date November 1st there. Now notice that if it's a credit entry, like we're making the common stock here, the date goes on the credit side as well. So in that case, the date's going over to the right-hand side. The date doesn't always go on the left. The date goes on whichever side of it you're putting the dollar figure on. Okay. Okay, second journal entry, purchase of land. They paid $20,000 cash for land. So we know that land is an asset account, so that's going to go up with a debit. We know cash is an asset account, and that's going to go down with a credit. So now we can prepare our journal entry. We show the debit to land, $20,000, and we show the credit to cash to show it going down, $20,000. And for the explanation, we say paid cash for land. Then we post to the ledger, so we find the T account for cash. We put $20,000 on the credit side of the cash account. Then we find the land account in the ledger, and we put $20,000 on the debit side of the land account. Notice here with the T account for cash, when we're making our second entry to the cash account, we don't have to go down to the second line. If there's a space available on the first line, like there was here, we can put it on that same line. So just fill in any spaces immediately with the entry that you have to make. Don't always feel that you have to skip down to the next subsequent line after that, okay? Okay, then they buy $500 of office supplies on account on November 3rd. So office supplies is an asset account, so we're going to show it going up with a debit. And then when they say on account in this example, it means that the liability account called accounts payable is going to be affected. And liability accounts would go up with a credit, so we know we're going to show a credit to accounts payable. Then we say that we purchased office supplies on account. Then we find the T account for office supplies. we put $500 on the debit side of that account, and we find the T account for accounts payable, and we put $500 on the credit side of that account. Okay, then on November 8th, Smart Touch Learning collected cash of $5,500 for service revenue that the business earned by providing e-learning services for clients. So cash is going to go up. Since it's an asset account, it goes up with a debit. So we debit cash for $5,500. Then service revenue is a revenue type account that goes up with a credit. So we credit service revenue for $5,500. Then we put our explanation for it. Then we find the T account for cash. We put $5,500 on the debit side. And we find our T account for service revenue, and we put $5,500 on the credit side. Okay, then on November 10th, Smart Touch Learning performed services for clients, for which the clients will pay the company later. The business earned $3,000 of service revenue on account. So in this case, when they say on account, we know that accounts receivable would be affected. So accounts receivable is an asset account, so it would go up with a debit. So we show a debit to accounts receivable for $3,000. Then service revenue is a revenue account that goes up with a credit. So we show a credit to service revenue of $3,000. Then finding the T account for accounts receivable, we put $3,000 on the debit side of that, and we find the T account for service revenue, and we put $3,000 on the credit side of that T account. Okay, then next, Smart Touch Learning paid the following cash expenses on November 15th. Office rent, $2,000, and employee salaries, $1,200. So expense accounts, we know go up with a debit. So we debit rent expense, $2,000. We debit salaries expense, $1,200. And then there's only one account here that we have to credit, which would be cash, and that would be $3,200. Cash is an asset account. Asset accounts go down with a credit, so that's why we're crediting cash. Now notice that with this journal entry, we had two different accounts that we debit. Therefore, this journal entry is what we would call a compound journal entry. A compound journal entry has two or more debits, or two or more credits, or two or more of both. And that's, in this example, it's perfectly acceptable to have two debits and only one credit. What matters is the total dollars of debits have to be equal to the total dollars of credits in order to keep the accounting equation in balance. So if we add up the total debit dollars here, they add up to $3,200. Our total credit dollars are $3,200. So we know that we're in balance with regard to making this journal entry. So everything should be okay here. Okay, then on November 21st, Smart Touch Learning paid $300 on the accounts payable created in transaction 3. So they're paying off some of their accounts payable. When we recorded the accounts payable in transaction 3, that was a credit to accounts payable because it was a liability account. So now, when the liability account is going down, it would be a debit to accounts payable. So we debit accounts payable for $300, and cash, which is an asset account, is going down. That would be a credit, so we credit cash $300, and then we find T accounts again for cash and for accounts payable to record those amounts in the ledger. Okay, on November 22nd, SmartTouch Learning collected $2,000 cash from a client in transaction 5. Transaction 5 was when we recorded accounts receivable. When we first recorded the accounts receivable, it was a debit to the asset account. So now when some of the accounts receivable are being paid off, we know that's going to be a credit to the accounts receivable asset type account. Cash is going up, so that would be a debit to cash, $2,000. Accounts receivable is going down, so that's a credit to accounts receivable, $2,000. And then we find the T accounts for cash and accounts receivable in the ledger, and we record the debit and the credit to those T accounts as well. Okay, then we have payment of a cash dividend. It's a $5,000 dividend. Dividend accounts go up with a debit. This rule might be hard to remember for dividends, but if you refer back to that diagram, it would tell you that dividends go up with a debit. So we will debit dividends $5,000. Cash is going down, so we credit cash $5,000. And then we find the T accounts in the ledger for cash and for dividends, and we record the debit and the credit there. Okay, on December 1st, SmartTouch Learning prepays 3 months office rent of $3,000. This is a topic that we're going to talk about a lot next week in chapter 3. So I don't even know why the authors get into this in chapter 2. But basically, if you're prepaying rent, it doesn't count as an expense because you haven't used up the rent yet. An expense is something you use up, right? Yeah, instead it's an asset. An asset is something that has economic value for you in the future, which prepaid rent does have. So this prepaid rent would go on your balance sheet as an asset. So to show the asset account called prepaid rent going up, we would debit that account for $3,000. And to show cash going down, we would credit cash $3,000. And then we would post to the T accounts. Okay, then on December 1st, SmartTouch Learning paid employee salaries of $1,200. So we said before, expense accounts go up with a debit, so we debit salaries expense $1,200. Cash is going to go down with a credit, so we credit cash for $1,200. Then we find the T accounts in the ledger and post those amounts to the cash account and to the salaries expense account. Okay, then next, on December 1st, SmartTouch Learning purchased a $60,000 building in exchange for a note payable. So basically, they financed the purchase of the building with a loan. There was no cash involved in the transaction. It was entirely a loan. Yes.
So if it was paid in cash, what would it be?
What would it be?
Yeah, so that, like, for instance, the note
Mm,
is represents of a loan.
yeah.
Would it be land?
No,
No?
if cash were involved, just where it has notes payable here being credited, you'd, credit cash instead.
Okay.
But they're different because notes payable is a liability account, we credit it because the liability account's going up. If it had been cash, that's an asset account, we would credit it because the asset account's going down.
Okay.
So the reasons are a little bit different, but yeah, we just would substitute, cash for notes payable. So notes payable is the name of a liability account, it goes down with the credit. Okay, on December 2nd, Smart Touch Learning received a contribution of furniture with a fair market value of $18,000 from Sheena Bright. In exchange, Smart Touch Learning issued common stock. So, in small corporations, when you're issuing common stock to your stockholders, it's not always because they put cash into the corporation. Sometimes they own some other type of asset that they put into the corporation, such as in this case, furniture. So the corporation is really buying the furniture from Sheena Bright, and they're paying her for it with shares of common stock. So furniture is an asset, and so we would show the furniture account going up with a debit. Common stock is an equity account. Common stock goes up with a credit, so there's a credit to common stock there of $18,000. Okay, then on December 15th, Smart Touch Learning received a telephone bill for $100 and will pay this expense next month. So here, depending on what their chart of accounts said, some companies would use accounts payable for this, but if they have an account called utilities payable, then that's more specific than accounts payable. So it would probably be better, like they're showing here, to put it into a liability account called utilities payable. So it's the expense account that we're going to debit, utilities expense $100, and then the liability account, utilities payable, will be credited for $100. Okay, then on December 15th, Smart Touch Learning paid employee salaries of $1,200. So we debit the expense account, salaries expense, $1,200. We credit the asset account cash, $1,200 to show that going down. Okay, on December 21st, a law firm engages Smart Touch Learning to provide e-learning services and agrees to pay $600 in advance. Okay, this is another topic that is going to come up in Chapter 3. If you haven't provided the services to the client yet, then you're not allowed to treat it as revenue, even if you've already collected the cash. Basically, you haven't earned the revenue yet because you haven't provided the services yet. So what you do with the $600 is you put it into a liability account, and the name of that liability account here is unearned revenue. The reason you put it into a liability account is, if you want to rationalize this, is that if for some reason you never provide those services to the client, then you're going to have to refund that $600 to the client. So it's a liability to you until such time as you actually provide the services. And then once you've actually provided the services, then you would move the $600 from unearned revenue on the balance sheet into service revenue on the income statement. So here on December 21st, we debit cash because we're taking in cash, $600, and we're crediting the liability account unearned revenue for $600. Okay, on December 28th, Smart Touch Learning collected cash of $8,000 for service revenue that the business earned by providing e-learning services for clients. So here they actually have provided the services, so this is more straightforward. We take in cash, so the asset account called cash, we would show a debit to that of $8,000. And then service revenue being a revenue account, that goes up with a credit, so we would credit service revenue for $8,000. Okay, so now we've done all of our journal entries, and if we determine the balance in every one of our T accounts in the general ledger, this is what it would look like. So this really could be the general ledger for the company that you're looking at. And notice that if you look at the totals of the balances for all of the asset accounts, they add up to $114,700. If you were to add together the totals for the liability accounts and the equity accounts, combined, those two figures would add up to $114,700. So we would be proving here, by doing that our accounting equation remains in balance after we have made all of these journal entries and then posted them to our ledger. Okay, the way that we go about proving that our accounting equation is still in balance is usually by preparing the document that you see on this slide, which is called a trial balance. Now, a trial balance is a report that is used to make the accounting process easier and more accurate. It's not a financial statement, unlike a balance sheet. It's not anything that you would ever issue to your shareholders. It's an internal tool that you use in the accounting process. Furthermore, there's nothing in GAAP accounting that says that you have to use a trial balance. But in most companies, they do use trial balances just to make sure that their work is accurate and to be able to find any errors that there might be in the accounting process. So what you do with a trial balance is that you list all of the account names, and then if the account has a debit balance, you put the account balance in the debit column. Likewise, if the account has a credit balance, you put the balance in the credit column. One thing that I may have mentioned this last week, but I'll mention it again here. Just like with the financial statements, if an account has a zero balance, you don't show it at all here. That's possible that there'll be some accounts with zero balances. Just skip them, don't put them here at all. But then at the bottom of this trial balance, if we total the two columns, the debit column and the credit column, both of the numbers are the same. They both come up to a total of 125,400. So this is how we would prove that in fact our accounting equation is in balance and that we have not made any mistakes when we were entering our journal entries and then posting to our ledger. Now, the trial balance is then used to prepare our financial statements. And I'm not going to talk very much about financial statements in this chapter. We already talked about them in chapter 1, and then we're going to get back to them when we get to chapter 4. But just for review, we said that we always prepare the income statement first, and we calculate the amount of net income for the period on the income statement. Then that net income amount gets transferred to the statement of retained earnings, which is the second statement that we prepare. Then the balance sheet would be the third statement that we prepare, and that ending retained earnings balance from the statement of retained earnings gets transferred over to the balance sheet and put under stockholders' equity on the balance sheet. Okay, there's one financial ratio at the end of this chapter, which is the debt ratio. And the formula for the debt ratio is total liabilities divided by total assets. So this information would come from the balance sheet. And what the debt ratio tells us is the proportion of the company's assets that are financed with debt. You don't want the debt ratio to be too high, and what's considered acceptable really varies by industry. So if it were an electric utility company, it'd probably be acceptable to have a 60% debt ratio. If it were a construction company, you probably wouldn't want it to be over 30%. So it will really vary by industry, but you don't want there to be too much debt because you have to make regularly scheduled payments on your debt, and if you fail to make those scheduled payments, then your creditors can force you into bankruptcy. There are two ways that you can finance your purchase of assets. You do it either with debt or you do it with equity. So if the company's debt ratio is, do we have an example here? No, we don't. If the company's debt ratio is 60%, it means 60% of their assets are being financed with debt. The other 40% of their assets are being financed with equity. We have problems to go over together in my lab. Why don't we take a 10-minute break, and then when we come back, we'll start on the problems in my lab. Did anybody come